Thank you very much for having me here to present my work. And so I also apologize this theory paper, as Hui just mentioned in this session, is becoming progressively kind of drier and more boring. It's good that Hui gave some preparation for this. He already presented some model part, and so that might be helpful. I'm here, I think, more about proposing a question rather than providing a solution. So this is, by the way, this is a joint work with Winston Do and Itai Goldstein from Walton, and my student Zigang Li from Toronto. So in this paper, we think about how algorithms, AIs, and people interact in financial markets. So we don't have a draft yet. We only have some results, and the results are also very preliminary. And we try to think about how to sharpen the results and make it more kind of interesting. So I'm going to focus on the first part of my presentation, and mainly about some philosophical thinking. So what do we think about this question in the financial context? So in the morning, I learned a lot from the speakers, and also you know that people talk about how humans and AIs interact, and whether AIs will replace or substitute humans. And in macro models, people talk about whether they will destroy more jobs or create more jobs. So here we think about whether this is a problem in financial market environment. So we have been thinking about this question for a long time, at least kind of 2 years. We think the most difficult part is to think about how to define machine and humans. So that's kind of very challenging for us to think about these definitions conceptually. So in the morning session, the speakers talk about they are fundamentally different, and from a technology perspective. But for us, I think we are economic people, and for us, it's kind of become very much similar. It's rather than different, and it's more like the boundary between machine and human is more blurry. So I can give you some thoughts we have thought about, and there's 4 of us, and also I discussed this with many other friends like Ming Yang and Peng Fei. We think about why we think they are more similar. Probably before the AI revolution, so if you think about what people was machine, it's that one way you can think about people might be more structured. They have a theory. You can think about how the world will work, and you have some theory. You build on knowledge, write on something. You think about how the world will work. So it's more active. And if you think about machines, it's more like a tool. It's more passive. Something follow the instruction from people. Or if you think about the econ models, maybe the humans, the players, more like you have some preference, and you open the black box and derive their demand function, their decision rule. For machines, more like agent-based models, more like a reduced model. They have some rule, follow that. So this is something that's one way before the AI revolution for economics, to think about the difference between human and machine. But nowadays, if you think about the reinforcement learning, in particular ChatGPT, these kind of large language models, so the difference becomes kind of smaller. So they know that the machines, what they do is like you try and error, the reinforcement learning. You do something, get some reward, and more like a bandit problem in econ, and they try to make the algorithm will converge. Also, I think Zhang Fan, Zhang Zong, I mean in Chinese, I don't know how to translate that. Zhang Zong, so gave us some example, right, showing that those algorithms also become smarter. They can also make an inference, right? They sort of they have their own deduction, have their own framework, have their own theory, and you see the houses, and they take the flag, and they can make an inference. Typically, flag is on top of a house. They can make an inference. That means they have some theory, some structure in their mind. So this is the machine, and you think about the human. And I can give you some examples, something about myself, and so I never taught my children Chinese, and they just learn Chinese from observing. I chatting with my wife, basically. We never seriously taught them how to learn Chinese, and gradually they just learn how to use them. And you can also see the kind of improvement. So how the progress. So for example, sometimes so this one I might speak in Chinese. It's easier for me.当我跟他们说的时候，我们家里就说，哎，你们俩这样怎么样？他们就认为你们俩这个特质就是他们自己了。所以以后他们说什么时候的，比如说啊，他说，比如说爸爸妈妈我们要吃饭了，他会说爸爸妈妈你们俩要吃饭了，你们俩要吃饭了。我们也没有纠正他，我们只是说我们在平时在讨论的时候，他们就逐渐意识到你们俩是可以变化的，他就学到这个东西了。并且他那个动态的时态那个了吧，比如说我吃饭了，他就知道这是完成时。一开始他也不知道说我要吃饭或者我要吃饭了，他就逐渐能够区分开的 difference. So they learn this gradually. We never taught them seriously, but they learn this from observing. I think so over 2 years or 3 years they learn Chinese, and so I think they're more like a ChatGPT, learn something. And if you think also, I think another example I thought about and I chatted with Ming Yang. Yeah, on the train, we think about so people like sweet things, and I think why people like sweet things. Probably a million years ago, so we realized sweet things will provide kind of calorie, and so that will provide energy. So that will build into your genes. It's more like something that algorithm learning, right, from our ancient ancestor. So all these things we think philosophically from an economic perspective, with the machine and the people become very, very similar. So we don't know, we are struggling how to model them conceptual level at the economic level. I thought that's kind of most challenging part. And then so far, so we haven't got a kind of satisfactory answer to address that. We just have some try. And so that's why today I think we are more like proposing a question rather than providing a solution. So so next I'm going to talk about how we think about this and what's our first try. And even the simple model we think, it's simple for most economic people, but probably not very simple for general audience. But it's a very simple thing for academia people. It can generate a very interesting kind of implications. And people might think, for example, people might think that AIs will become smarter and smarter. They might replace people, replace humans. So we show that even if they convert, they become smarter in the limit. In equilibrium, you have an equilibrium fraction between human and machine. It's not the case. They will dominate. And we also think about what's implications for market quality and what we mentioned, the price efficiency and the market liquidity, all these kind of things. So that's the general question we are interested. So next, so what kind of framework we have? So far, I honestly tell you, so what we thought about this approach. So how we come up with the current model, which is very simple. We are not very particularly satisfied with the current setting, but we just want to show you even a very simple thing can give you some kind of results surprising. It's not very, it's counterintuitive. It's not very easy. So we start from this jargon called Grossman-Six model. It's basically Hui's model, just present to you. There's some asset. You can think about the asset as a stock, as anything, random. So that's the financial market. And then we think about there are two groups of people, so a group of players. The one group of player machine, the other group of player are humans. And we think about what are machines, starting from there. And the machines, we think about reinforcement learning. And Winston is a kind of expert in that area. And he said probably the Q learning is kind of the simple foundation. So we think about the Q learning is the machine. So basically the Q learning to model machine. And then we think about the thing, how to think about the people, how to think about the humans. So in the model, in the traditional theory, economic theory, typically people model human as very sophisticated players. So they know everything. They know how the world works. They try to maximize their preference. They have information. All this kind of very, very complicated. But if that's the case, there's no reason for people to introduce algorithm, so introduce machine learning, because they already know the world. You don't have to use the machine to learn anything. We think about, okay, now what's the kind of relative advantage of our machine relative to human? And probably we think the machine, the Q learning, try to learn the financial markets, the environment, and then we try to, starting from that point, think about how to model human. And that means the human probably lack a full knowledge about the financial market. And then we turn on to the behavioral economics literature to think about, okay, how people model this. And in the economic literature, the behavioral finance literature, it's called bounded rationality. So fully rationality means people are so smart, know everything. So bounded rationality, you don't know everything. And so that is how we think about this model. Basically, the machine are Q learning. The people are bounded rationality, and which is the bounded rationality about the market environment. So we use the so-called key level thinking. So this key level thinking is it's not the work. Okay, the key level thinking means that if the key is infinity, people fully rational. If key is very small, it's a key level is a sophistication level of people. So that's how we think about the model. Now, so what can we get from the interaction between Q learning and the key level interaction? I think there are two main insights. Okay, the first one, so we show that AI, the machines, they will, under Q learning, they indeed will converge. So even if they are small guys, they will converge like the so-called collusion. So they will internalize everything. This is psychology of machine. It's different from the psychology of humans. Psychology of humans, we model how they behave. It's like we open their mind. We think about how people think and how they behave. That's the psychology of human. The psychology of machines, like we use the Q learning, in the long run, they will converge as if they are like this. So that as if they collude. Initially, the small persons, small players, they don't collude, but from learning, they will collude. The intuition is like this. So although they don't know they are colluding, but they can try and error, and they get something and see whether it's good or bad. If it's bad, they just give up and then they try a good thing. And in the long run, they will converge as if they are internalizing everything. This is kind of the collusion part is very, it's kind of the key result of our paper. We show that. So probably from collusion, you might make an inference. If a lot of players try to collude with each other, they might internalize the externality, and then they might become stronger. So the direct implication is they will become more dominant relative to people. So that's only sort of like a partial equilibrium. We show that that's not a complete story. Because they collude, they become smarter, and they know that they behave as a large player. So if they move, they trade, they will move the price. For example, suppose now the asset is $100, they good chance to buy, and they will buy. They know that if they buy a lot, the price will jump into 110. So they will trade less aggressively. So trading less aggressive will make them generate less profits. So the sort of the advantage becomes a disadvantage. We will limit their kind of profit accumulation. So that's a sort of the one interesting result that we show that an AI person will convert to a larger player, will collude. The collude has a direct effect and an indirect effect. The direct effect will internalize externality, which is good for their dominance. The indirect effect, because they are smarter, they trade less aggressive, and the relatively stupid humans, they will trade more aggressive. So this will work against the machine. So in the equilibrium, I probably don't have time to show you. In the equilibrium, we show that the endogenous fraction of the machine. So that's a sort of so one result. Basically, sort of we try to combine two things: the Q learning and the K level, and show that this will kind of show you the limits to AI dominance. So this is the main result we think is interesting so far. Another observation we think is interesting is we show that also mentioned in the morning by some speaker. I think that probably Tom mentioned that. So the interaction, the smartness of the AI algorithm depends on their environment, depends on how who they interact with. So because their smartness comes from training data. If the data is stupid, so that will limit their smartness. So we do a counterfactual analysis to try to show that's the case. That's kind of what we found so far, and pretty much what you can get, I hope. And the next, pretty much you will get lost because this will become very, very kind of boring. How much time do I have? 5 minutes. It's perfect. I'm almost done with my main points. So now it's the theory part. The theory part of it, Hui already made a preparation to show you what's going on. So this is basically the Hui's model. You think about the asset, we have an infinite horizon model. Hui just have one period. So we have a repeated period. So each period you have an asset. You think about the asset as a stock. The asset is random. It's given by some normal distribution. So it's a unit randomness. As I mentioned, there are two groups of players. One group of players are humans. The other group of players are machines. The machines, they try to maximize their long-run profits by trading the asset. Also, in each period, they will receive some information. The information is captured by a signal. The signal is by the fundamental value plus noise. And the human, they also maximize their utility. They also get information. And so a cheap way to model human versus machines, if you don't think about it, try to come up with a new model, maybe you just think about probably the information precision will be different, or they have a different kind of expertise by the information perspective. So some people receive information by the A element, machine receive information by B elements. So, but we don't think that's interesting for a theory person. So there, another one is called the node traders. Node traders is basically, you think about that's the potential opportunity for people to make profits. Because in equilibrium, those node traders will lose money. The machine and the humans will gain money. You think about the node traders just the kind of potential size of the market, how much profit they can make. So that's the setting. This is how you think about the AI, the machine. The machine is basically the Q learning. What's the Q learning part? So we think the Q learning essentially is approximation to dynamic programming. So that's the kind of idea of Q learning. So you think about what the people do if you think about dynamic programming. The dynamic program, basically you try to maximize your long-term utility. It's probably have 10 periods. You try to change that 10 period problem into 10 2-period problem. You try to think about what will be my trade-off between today and tomorrow. But you recursively. So that's a dynamic programming problem. So this is given by the first equation. The first equation, the first term is today's payoff. The second term will be the future's, tomorrow's payoff. But the tomorrow will changing. So from today's perspective, tomorrow is the next day. But from next day's perspective, tomorrow is the day after tomorrow. So you have to define this structure recursively. So that's so-called dynamic programming. So what the Q learning does is to come up with an algorithm to approximate this. So they sort of relabel this value function to a Q function and change it to matrix representation, and then use the trial and error approach to show that in the long run, this is the computer scientist results. In the long run, this Q learning will convert to the optimal solution. So this is how you think about the Q learning. This is how you think about the machines. So next, you think about how to think about the people. Okay, the people in our model. Okay, the people. As I mentioned, what we do is we just borrow the behavioral economics literature to think about how to break down that common knowledge assumption. We use the bounded rationality. It's the key level thinking. Intuitively like this. If you are level 0, very naive. You just think about the partial equilibrium perspective. You just think about it, try to maximize your own utility. You have no knowledge about the market environment. You don't know there is the AI. You don't know there are other people. You just think about that you maximize your utility by yourself. So level 1, so the key level implies something called overconfidence. So level 1, we'll think he knows more than other people. So all the other people, level 0, he is smarter. So level K is so the investor is level K. Think other people, the level K minus 1. I only have 1 minute, and so this is how we model people, and tell you this is the main result. This is the main channel. The channel we show that the trading strategy. The trading strategy of human and machine are given by in equilibrium is given by the linear structure. So you can X is how much they will trade, and the eta is the information, the P is the price. So this is beta model, they are trading aggressiveness. You will see that in equilibrium, the machine, this one is always lower the coefficient than people's coefficient. So meaning the machine in equilibrium will trade less aggressive. The reason is they will become kind of the so-called Kyle agent. They will try to collude with each other. Their price impact will become smaller. So this is the key result. Will kind of work against their smartness, basically. And this is how we determine the equilibrium fraction of the human and the machine. And you think about initially you have 1 million traders. Some of them think about whether I will become a machine trader, buy more machines. The rest will become human. And when the machine traders profit higher than people, more traders will switch to machine. So only when they interact, the profit interact, there is a equilibrium fraction. So you see that it's not always the case in which the machine become more profitable than people. That two kind of working forces working against each other. So the direct effect, the machine kind of collude smarter, that will be better than human. But on the other hand, they treat less aggressive. So that's sort of the counteracting force. I think that's pretty much what I have. I still have some more results. I don't have time to present. And so thank you very much for listening.